Friends, we all have our favorite foods. Mine is dal makhni. So, what is it that goes into making a perfect dal makhni? I think it's the right ingredients in a right proportion. Isn't the same thing applicable for our portfolios too? So, for a healthy portfolio, we need a good mixture of different asset classes which suit our risk profile and give us returns that are as per our expectation. So, in today's video, friends, let's see what is the concept of asset allocation. So, friends, what is asset allocation? Theoretically, it means the act of deciding which asset classes to include in your portfolio and at what proportion so they maximize returns for the level of risk you're willing to take on. Let's simplify. So, in our life, in order to have a happy and healthy life, we need a good combination of work, activities that involve personal development, activities that enhance and make our relationships stronger, spiritual activity, and something that's good for our health, both physical and emotional. Depending on at what stage of our life we are at, all these different activities demand different amount of time. For example, if there is an assignment that's due in office, or if there is a new product launch, obviously we'll be spending more time on work. Compare it with the situation when you're welcoming a new member in the family, or if a loved one is not keeping well. In that situation, you'll spend more time in your relationships. That's how life is. Depending on the life stage, depending on the circumstances, we spend time on different activities. Now, just let's compare this time management with your money management. Replace time with money. The same framework applies to wealth. So replace work, relationships, personal development, physical and mental well-being activities with asset classes and see how much money you would be allocating to equities, that is to stock markets or mutual funds, or to bonds, goals, and real estate. So, depending on your long-term financial goals and short-term financial goals, depending on what's the current situation of your financials, what is your age, how many dependents are there on you, what is the time horizon you're looking at, what is your risk appetite, how would you react if your portfolio goes down by a large extent. Consider all these factors, and that's when, with the help of your financial advisor, what you can do is you can allocate a certain amount of money to different asset classes. That's, our friend, is called asset allocation. So there are multiple asset allocation strategies. In our today's video, we'll be taking a look at 5 most important asset allocation strategies. So we'll begin with strategic asset allocation first. If you're a long-term investor and you don't have much information about financial markets, then typically that's the kind of strategy that will be more relevant for you. The reason for that is, in a strategic asset allocation, what an investor does is you can sit and decide, looking at all these factors that we just looked at: age, your financial status, your goals, number of dependents. You take a look at all those factors, and then based on that you decide how much money to allocate in each asset class, and then you keep that allocation for a longer time horizon. That means you don't touch your investments and let them grow on your own. A very important thing here is to understand that you need to have a good understanding of all these asset classes in the beginning when you're doing the allocation exercise. You can take help from your financial advisor. That's what we'll also suggest, that it's better to take advice from a financial advisor if you don't know much about the financial markets. So it's a typical buy and hold strategy, which is a long-term strategy, of course, wherein the time horizon goes up to a decade as well, right? So now you understand understand when we say long term, what do we mean by long term? It's up to 10 years of time horizon that we're currently talking about. So the second strategy is tactical asset allocation. So tactical allocation generally is followed by investors who have a medium term horizon. When we say medium terms, it is between 5 years to 7 years, wherein you decide the allocation in the beginning, and as per the movements that are taking place in the market, you take advantage of the opportunities that are arising in the market, right? So what do we mean by that? So suppose looking at the current situation, if you think there is a recession that's looming in the near future, then what an investor can do is they can allocate more assets to conservative asset classes. When I say conservative asset classes, it means giving more allocation to debt, fixed income kind of assets. Some investors are also holding on to cash. So basically, you keep an eye on the market movements, but not very frequently. You don't have to rebalance the portfolio very frequently, but you do keep an eye on the market situations. And if there are good opportunities that are coming in, you change the allocation of these asset classes, right? So suppose in the beginning, you thought that you'll give 60% allocation to equities and 40% to debt. Depending on the situation, if you think there is an impending recession situation that may come up, you can give more allocation, say 50% to debt now, and reduce the allocation of equities from 60% to 50%. So I'll say it's a mix of both active and passive investment. You're not meddling with your portfolio very frequently. Simultaneously, you're not completely ignoring your portfolio. So it's a mix of both active and passive management. So friends, if you need help in your financial planning journey, you can use our offering FinPlan Yadnya in order to help you build your financial plan. So there are more than 15 Excel calculators and a wide variety of templates that are available on that knowledge bank in order to help you with the DIY financial planning. So the third type of strategy is dynamic asset allocation. As the word says itself, it means you're making frequent changes to your portfolio depending on the market events. So it's a strategy which is typically used by hedge funds and mutual funds and a lot of other institutional investors. So what they do is they keep a eye on the market events, and based on these market events, whenever there is any opportunity coming, they reallocate the portfolio. So there's no fixed or there's no target allocation that takes place in dynamic strategy. So the allocation to equities or stock markets can go up to 100% and also up to 0% depending on the situation of the market, right? So it's typically I'll say it's a very active strategy, a very active investment strategy, and it should be followed by investors who are up to date with the market events. It's for the investors who are closely monitoring their portfolios and are ready to make changes in the portfolio as and when there is an opportunity arises. So it's typically the kind of strategy that is followed is you buy low and sell high. It doesn't the downside of this strategy is because there is a lot of churn that's happening in the portfolio, the transaction costs will be higher, right? So we'll suggest this is a good strategy for investors who are up to date what's happening in the market. So the fourth type of asset allocation strategy is constant weighting asset allocation strategy. It's a combination of strategic asset allocation along with rebalancing. Rebalancing, that's a new term I'm using. What it means is your rebalancing means revisiting your portfolio to bring the allocations back to the initial level. What does that mean? Let me simplify. So suppose in strategic asset allocation, you gave an allocation of 60% to equities. So let's say these equities include stock market investments, direct stocks, along with equity mutual funds, and 40% allocation to debt. So let's say that's a combination of some fixed income mutual funds and say fixed deposit, right? So let's assume over time your equity investments grew at a higher pace as compared to your debt investments. Okay, so what has now happened is, because the equity investments grew at a higher speed, their allocation, their weights in the portfolio have also gone up. Okay, so let's just say that let's assume that the weights of these equity investments have now gone up to 70%. That means your debt has reduced by 10%. Debt now comprises 30% of your portfolio, but your initial allocation was 60% and 40%. So what you'll do is, you'll sell 10% of these equity investments to bring it down to the initial level of 60%, and you'll buy 10% of these debt investments to bring it back to the earlier level of 40%. That's what we mean by rebalancing. Okay, and you determine the frequency of this rebalancing. It could be a 6-month frequency, or it could be a yearly frequency. So in terms of the rebalancing frequency, you can decide that frequency in discussion with your financial advisors. Many of the investors follow a 5% rule. What do I mean by that is, if the value of any of these asset classes increases or decreases by 5%, that's when you rebalance the portfolio to bring it back to the earlier level. Okay, so that's one of the thumb rule that many of the investors use in order to help them with the rebalancing exercise. Fifth asset allocation strategy is insured asset allocation strategy. It's very suitable for investors who have a low risk appetite and who are more conservative in nature. So what happens in this asset allocation strategy is, the investor determines a base portfolio value. And what do I mean by a base portfolio value is, suppose I have a portfolio which is worth 1 lakh currently. I decide a portfolio base value of 90,000. What do I mean by portfolio base value is, I'm not comfortable if my portfolio goes below 90k. Okay, so that's the threshold that I'm deciding currently. If my portfolio will fall below this level, I'm going to reallocate my money to more conservative asset classes. So I'll reallocate my money more to say fixed deposits or to debt kind of instruments. But if my portfolio value increases, say if so from 1 lakh it becomes 1,20,000, I'll continue following the active investment approach. I'll keep on looking for more opportunities to invest. So basically in this strategy, we are minimizing our downside risk, and we are okay with any upside return that we are going to get because of the returns that our asset classes are going to give us. Okay, so these are the 5 commonly used asset allocation strategies that are used by investors. Friends, there are detailed videos also available on these investment strategies, wherein we have taken examples and explained each of these strategies in details. The link of these videos is mentioned in the description, so feel free to watch these videos to gain more in-depth understanding of these strategies. Friends, will also be coming up with a video on rebalancing, that is how to rebalance your portfolio. Thanks for watching today's video, and keep watching this channel for more such content. Jai Hind.